A question I'm frequently asked is around the books one should read to improve their understanding of investing and wealth creation. Understandably, it's not an easy one to answer because every person is at a different level and the kind of topics that appeal to each one is also varied. So when I asked ChatGPT to give me a list, I wasn't surprised when I received these names. The Intelligent Investor by Benjamin Graham, and I already have a video on this. A Random Walk, Common Stocks by the great Phil Schiller, of course Peter Lynch's One Up on Wall Street, the classic book on financial independence, Rich Dad, Poor Dad, Common Sense Investing by John Bogle, and the book that ushered us into an era of calculative investing, The One and Only Security Analysis, again by Ben Graham. So the usual suspects were all there, and in fact Security Analysis was the first book I ever read, partly because it was compulsory reading in Professor Bakshi's class, but other than this list, some additional but usual titles would include Buffettology, which explains Mr. Buffett's rules in a simple readable format. Margin of Safety by Seth Klarman is one book I highly recommend. 100 Baggers by Christopher Mayer. And within Indian titles, I would look at Value Investing and Behavioral Finance by Parag Parekh, Diamonds in the Dust by Saurabh Mukherjee, The Thoughtful Investor by Basant Maheshwari, and Deepak Shenoy's Money Wise that I'm sure some of the younger folks and especially beginners would enjoy reading. What am I reading now? Well, it's this recently released book by Morgan Housel, Same as Ever, which includes some 24 short stories that are designed to improve our understanding of risk, opportunity, and how to navigate the uncertainties of the future. It seems interesting. I haven't read it yet. I just got my copy yesterday. But this video is not about any of these popular books and authors. In fact, the 6 books I have chosen for you are not that popular. You won't find them prominently displayed in bookshelves. Even Amazon and Flipkart won't recommend it. But in my opinion, these are some of the best pieces of investment literature I have come across. And in this video, I'll be giving you a brief synopsis of each of them. And if reading is something that interests you, you'll be happy to know that the first edition of my newsletter is out with a couple of very interesting investing specific stories. The first one is on the TCS buyback, and I'll be examining mathematically if tendering one's shares is worth it or not. And the second story I have is a bit investigative as we look at the reason why the price of BSE Limited has gone up by over 300% in the last 6 months. I do hope you enjoy these pieces, and if you find them useful, then do encourage your friends and colleagues to also subscribe to my newsletter. With that being said, let's start with the first book in our list. When Peter Bernstein released the first edition of his book, Against the Gods, A Remarkable Story of Risk, remarkably, in hundreds of years and millions of books, this is perhaps the only book that has ever been written on the history and evolution of risk. I mean, we talk about risk almost on a daily basis with words like beta, volatility, stop loss, etc. But surprisingly, most of us have never been introduced to the history of it, including some very elementary questions like how risk evolved over the years, or what has been the impact of risk on the human civilization, let alone the financial markets. In fact, let me take some examples from the book to emphasize how impressive this book is. For example, maritime insurance is not a modern innovation, but it came up in ancient Babylon, so some 4,000 years ago, when to mitigate the uncertainties of sea voyages, the Babylonian merchants devised a form of insurance wherein they would divide their goods amongst multiple vessels, thereby spreading the risk of loss. Later in the book, Bernstein jumps to the Renaissance period when there was a lot of intellectual curiosity, and here's a mathematical example of that era that I really liked. So two players A and B are playing a game called Bala, and per the rules, the first to reach 6 points wins the game. Now in this particular game, there is a lot of money at stake, about 53 Florentine florins, which comes to about $10,000 in today's money, and for some reason the game was stopped when A had won 5 points while B was at 3 points. Now the question to you is, how should the money be divided between player A and player B? In other words, what is the probability that A, who is leading the game, would actually be the first to win 6 points? And while the answer is not difficult from a mathematical perspective, remember we are talking about the 14th or 15th century when maybe a handful of people even thought about what a probability is. So if you're with me so far, then a third instance I want to share from the book is on the perception of risk. So the human factor starts coming in now, and Bernstein specifically refers to Daniel Bernoulli, who first observed that a gain of $100 was worth more to a man who had only 100 to start with than a man who had started with $1,000. And conversely, the loss of $100 would be a lot more painful to the first person as compared to the second, which as a concept was then coined as utility and is something you might have read in the 20th or 21st century in your microeconomic textbooks. My point is, if you like history as much as I do, then you love this book, and from ancient abacus, the rolling dice, the Greeks, anities, gambling, military tactics, probabilities, economics, Galileo, Descartes, the Bayes theorem, the Galton board, scientific research, and of course investing, this book surely has something for everyone. Charles Mackay wrote the book Extraordinary Popular Delusions and the Madness of Crowds in 1841. Yes, 1841. And the book continues to be a timeless reminder of irrational behavior, especially during times of euphoria, fear, and uncertainty. Since the book was published over a century ago, there should ideally be no copyright here, and I'm sure you'll be able to find a free copy on the internet. So the book covers different stories of its times and is a fantastic exploration of human psychology, crowd behavior, mass hysteria, and of course speculative manias. The first and perhaps the most popular of such speculative bubbles is the Tulip Mania of the 1630s that happened in the country of Netherlands. You see, tulips were introduced to Europe by the Ottoman Empire, and very quickly they became highly sought after for their vibrant colors and unique patterns. As the demand rose, their prices skyrocketed and the tulip bulbs began trading at exorbitant prices. In fact, at the height of the bubble, tulips sold for approximately 10,000 guilders, which ludicrously was somewhere close to the value of a mansion on the Amsterdam Grand Canal. So it was a case of FOMO, the fear of missing out, and people from various socio-economic backgrounds, including merchants, artisans, and even commoners, were caught up in the frenzy of tulip trading. The speculative bubble reached its peak in the late 1636, and by February of next year, the prices had collapsed dramatically, with many people in financial ruin and the Dutch economy in complete tatters. A second and an equally interesting piece of hysteria covered in the book is the South Sea bubble of 18th century England. So the South Sea Company was established in 1711 and was granted a trading monopoly on South America, particularly the Spanish colonies. While the early years were relatively stable, in the year 1719, buoyed by speculation, investors started buying more shares in the company on the promises of immense profits from trade in the South Seas. Expectedly, other companies also started capitalizing on the euphoria by launching ventures and issuing stocks based on dubious or unfeasible business plans. In fact, the South Sea Company used every questionable tactic in the book, including the services of market operators, prominent politicians, and even influential figures who were the influencers of those times, to increase the public's confidence in the company's prospect. But as it always happens, by the middle of 1720, the South Sea Company's stock price had reached astronomical levels, and the bubble eventually burst in September of that year, leading to massive panic, and thousands of investors lost money in the process, including Sir Isaac Newton, who lost $3 million in today's money. This led to the government enacting many regulatory reforms, including the Bubble Act of 1720, which was aimed at curbing speculative excesses and limiting the formation of new companies. The book looks into many more such stories, including the Mississippi Bubble, the Crusades of Europe, the Dutch East India Company stock bubble, the fascination with alchemy, etc. Of course, the modern day version of these events would include things like the dot-com bubble of the late 1990s and early 2000s, the housing market and subprime crisis in the mid-2000s, the Japanese real estate bubble in the 1980s, the cryptocurrency boom and bust of 2017 and 18, the Chinese property market, and much more, making this book a wonderful reminder of what Mark Twain once said, that is, while history doesn't repeat itself, it definitely rhymes. The third book in my list is Stocks for the Long Run by Jeremy Siegel, wherein the author makes a compelling case that stocks historically have provided far higher returns over the long run, and that they have done it with less risk as compared to other asset classes. The book can be thought of as one of those data-intensive studies, and there are a couple of wonderful lessons we can derive from it. The first lesson comes from one of the most important charts in the book, which shows the stock market's total real returns, so nominal returns minus inflation, from the year 1808 onwards as compared to other asset classes. In numbers, $1 invested in stocks in the year 1808 would have yielded over $700,000 after adjusting for inflation, while bonds would have given this investor just $1,778, which is almost nothing. Even market crashes like the Great Depression of 1929 looks like a small blip in this chart, adding fuel to Mr. Siegel's point that no other asset or commodity offers the stability of long-term real returns that the equity markets offer, although in the short run, stocks are definitely more volatile, having been driven by factors like risk, uncertainty, interest rates, earnings, and even psychological factors like optimism, pessimism, and greed. The second lesson from this book is something we don't hear often, and Jeremy Siegel says stocks are less riskier than bonds. He explains it using this chart, wherein we can see the highest and lowest return across asset classes across different time periods, and stocks are unquestionably more volatile than bills or bonds over the 1, 2, or even the 5-year period. But when we look at it over a 20-year holding period, then this data from 1808 until 2012, so that's 200 years of data, it clearly shows that stocks have never fallen below the inflation rate when examined on a long-term basis, that is 20 years or more. On the other hand, notice that bonds and bills actually fell below the inflation mark by up to 3%, establishing a very useful thought premise that not only do stocks offer more returns as compared to bonds and bills, but over the long run, equities as an asset class are also a lot safer. On a rolling basis, this table here shows that as the holding period increases, the probability that stocks will outperform fixed assets increases dramatically, and over a 30-year horizon, stocks have outperformed bonds almost 100% of the times. Other than these data-led lessons, the author, Mr. Siegel, has also made a case for investing in indices via index funds or ETFs, as it not only spreads the risk but also offers fantastic returns over the long run, and has also advocated the buy and hold strategy, which is again in line with the long-term holding of equity instruments. So net, go for equities and keep it for the long run. The book Reminiscences of a Stock Operator is a chronicle inspired by the life of Jesse Livermore, a legendary stock trader from the early 20th century who earned millions in the stock market several times and would also lose that money quickly thereafter. The book is very well written and a captivating narrative that provides insights into the psychology of trading and the world of financial markets of that era. In fact, chronologically, there are 3 parts to the book. The first is the period from 1890 to 1910, when Jesse Livermore was able to make easy money by taking advantage of the bid and ask spread of inactive stocks with a leverage of 100:1. Then came the next 10 years from 1910 to 1920, when the protagonist was a stock trader on the New York Stock Exchange, and finally the 1920s, when Livermore engaged in market manipulation, often charging a fee of up to 25% of the value of the manipulated stock. The book dwells into the mistakes he made, what he learned from them, how did Livermore overcome the challenges, and of course, some part of his trading strategy was also covered. For example, one of the strategies Livermore followed was an incremental or a probing approach, wherein he would slowly build his position in a certain stock or commodity by buying or selling blocks of the security until he reaches his target. However, if the ticker tape doesn't confirm his outlook, that is, the price goes in the opposite direction, then he would acknowledge his mistake and exit that position. The book explains this and much more through different entertaining stories, as it also sheds light on the mistakes and the virtues of never trusting anyone else's stock tips, never to cash out quickly for a small profit but rather ride one's investment out, how to follow trends, understanding of market sentiments, to be mindful of reckless speculation, and to quickly adapt to changing conditions. Net, the book serves as a cautionary tale and as a source of valuable lessons for traders and investors as we learn more from Jesse Livermore's experiences And despite being set in the early 20th century, I think the book's lessons remain very relevant in today's financial markets as well. Okay, here's a book I've covered in the past, and although the canceling method makes this book all the more popular, I think William O'Neill did an incredible job of capturing different facets of money making in a single book. In fact, there are three lessons I could draw from this book. Number one is quality and the related methodology. The canceling method is a combination of 7 essential variables, which includes a stock's current earnings per share, the annual increase in earnings, so the acceleration in per share profits, the presence of a catalyst in the form of a new product, a new management, or a new direction, supply and demand, which is measured by daily trading volumes, the identification of leaders and laggards, and obviously industry leaders are preferred. I stands for institutional sponsorship, whose job is to provide buying support and continuous liquidity. And finally, there is market direction, which involves the reading of price changes and checking volume indicators. The second lesson I could draw from the book is on the virtues of reading charts, and William O'Neill literally converted that book into an encyclopedia of charts. So according to him, the ability to decode price movements is the key to making money in the stock market, and one should not rely solely on fundamental characteristics like sales growth, cash flow, ROC, and so on. He recommends one should always carry out a technical analysis before investing in any stock, and this knowledge can help you spot patterns and therefore predict price movements, including the right entry and exit points. And the third section of William O'Neill's book, and something many of us ignore, is on when to sell a stock, and O'Neill offers up to a dozen indicators that can help us determine when to sell and at what price one should explore selling. In my opinion, this is one of the better books on investing, and I'm really glad I read it earlier this year. And the last book in my list is When Genius Failed by Roger Lowenstein, that is centered around the rise and fall of LTCM, long-term capital management, which was a hedge fund in the 1990s led by the most brilliant minds in finance and economics of that time. So essentially, LTCM used mathematical models and complex trading strategies to profit from small discrepancies in global markets, and it seemed to be working very well, with the fund generating massive returns, and it also used leverage to amplify those bets. But in 1997, when the Asian financial crisis erupted, which was closely followed by the Russian debt default of 1998, it triggered a chain reaction that exposed LTCM's highly leveraged positions, leading to margin calls and substantial losses for the fund. In fact, when the losses approached $4 billion, the US government and a consortium of major financial institutions had to orchestrate a bailout to prevent a catastrophic domino effect on the global financial system. So essentially, the book throws some caution to the wind in terms of the perils of excessive leverage, the over-reliance on complex mathematical models, unforeseen systemic risks that can emerge in times of market stress, and the dangers of assuming that past market correlations would persist indefinitely. So history can be a fantastic teacher, and I think this book and many of the others I have shared do a fantastic job of delivering some important lessons, however painful, on what we should be doing and what we should be avoiding when participating in the stock market or when creating wealth. As you can see here, I've tried to recap the learnings from each book, and if you've been reading some other books on investing, finance, money making, or even life in general, and would like to summarize the top 5 learnings or even recommend that book, then please feel free to use the comment section below. Once again, thank you for your time. Hope you are enjoying the newsletter, and I'll see you 3 days from now. Until then.